annual Los Angeles Homebuyer Conference. For years, the Valley Economic Alliance has hosted this event as a way to educate the community and bridge the gap on generational wealth. The Alliance is a catalyst for economic development in the San Fernando Valley region, which includes Burbank, Calabasas, Glendale, Los Angeles, and San Fernando. Our business assistance, job placement programs, and affordable housing programs assist scores of residents every year. And this program today is another shining example of what we can do together to create a prosperous region. There are opportunities in every market, and it is clear that the real estate market today is still vibrant, even in the current climate. Education on home ownership, grants, loans, and the market in general have proven to be beneficial to our Los Angeles communities. I'd like to take a moment to first recognize our sponsors for their important support of this event. A very special thank you to our presenting sponsors, Boston Private and Bank of America. Our panel sponsors, HSBC Bank and SB Realty. Our community partner, Ventura County Community Development Corporation, and to our media partner, the San Fernando Valley Business Journal. Thank you for your partnership. In a few moments, we'll start our panel. But before we do that, I'd like to introduce our distinguished presenting sponsor, Kerwin Esperias, Area Lending Manager from Bank of America. And Kerwin will say a few words before moderating our panel discussion for this morning. I hand it to you, Kerwin Esperias.
Thank you, Sonia. So like Sonia mentioned, guys, my name is Kerwin. I'm happy to be here with you guys this morning. And really, I applaud your commitment to learning more about home ownership and taking the time to really increase your knowledge on the home buying process. Today, we're going to hear from different panelists about different products they might have at their own institutions, and which is awesome. But I wanted to let everybody know about something that I think is really cool. So last year, Bank of America announced a $5 billion community homeownership commitment. That's billion with a B. So this commitment from Bank of America specifically addresses some of the most common barriers that most of us have towards homeownership. And the two that I'm the most passionate about are down payment and also closing costs. I think those are some of the biggest barriers that most of us have in buying a new home. So my favorite parts of our commitment is the two grants that we have. So we have one grant that's called the America's Home Grant, and that grant is up to $7,500 towards non-recurring closing costs, like your title insurance, like some of the escrow fees. Now, there are some stipulations on how to qualify for the $7,500 in closing costs, but it's a great way to help somebody with closing costs. And it's also a great way, if you have some additional funds left over, to buy down the interest rate to make your monthly payment even more affordable. So that's one grant. The other grant that I'm excited about is our down payment grant. So this is 3% of your purchase price up to $10,000. Again, there are some restrictions, there are some limitations. But again, if you combine both of these grants, which again, these are grants, these are not silent seconds, these are not loans, this is free money that you do not have to pay back. You do have to qualify for it, but you can get up to $17,500 in free money from Bank of America. So again, just wanted to let you know about our $5 billion homeownership commitment, specifically about the two grants. And Cornell, one of our panelists, will touch a little bit more about these during the panel, but I just wanted to give a quick plug for those grants. And again, thank you again, guys, for making time to learn more about the home buying process. So with that said, I want to transition to our panel. And in doing some research about our panelists, I was really excited at the amount of experience that you're going to hear about today. So between Alex, Fernando, Cornell, and Karen, you have over 110 years of lending experience. So obviously we'll let everybody introduce themselves and share a little bit of background, but I was just very deeply impressed with the amount of experience that we're going to get to learn from and really discover some products, some options, and really some best practices to buying our first home or our next home. So I want to first, again, thank all of our panelists. I don't think Alex made it on the call yet. Alex, are you there? All right. So no problem. So again, you guys, hopefully everybody in the audience can see our panelists. We do have Fernando from HSBC, Fernando Garces. We have Karen Crosby, a senior mortgage advisor from Finance of America. And we have Cornell Hunter, a community lending officer with Bank of America. So I'd like to first start off with Cornell. Cornell, can you tell us a little bit about yourself, about Bank of America, in regards to your background, your experience, and any best practices that you have for home buyers?
Absolutely. And thank you for the introduction, Kerwin. I appreciate it. And I, too, obviously and clearly appreciate Bank of America's commitment to affordable home ownership, and particularly in the diverse segment. I'm Cornell Hunter. I've been in the industry since I got out of the Marine Corps in 1976. So probably 2/3 of that 110 years that Kerwin is talking about is probably attributable to me. I'm especially excited to be with Bank of America now because of its clear commitment to first-time home ownership and to home ownership in the diverse segment. I'm on the board for the Inland Empire Association of Realtors, which is a group that was started in 1947 before blacks could even use the term realtor, and they created a group called the National Association of Real Estate Brokers. I say that because they put out a report every year called SHIBA, the State of Housing in Black America, and it shows that black home ownership is about 42%, while white home ownership is in the 70s. There's a 26 percentage point gap between black and white home ownership. So this panel and this group and this initiative is all about changing that, because there is something that you'll hear more about as we go forward, and that's called legacy wealth. And if you don't start off in a home ownership capacity, then your ability to leave a legacy behind is, of course, a moot point. So Cornell Hunter, Bank of America, excited to be here and looking forward to talking to you about our programs and products.
Perfect. Thank you very much, Cornell. So next, I'd like to bring on Karen. And again, Karen is a senior mortgage advisor with Finance of America. And not to brag about Karen, but Karen has closed over 4,000 transactions nationwide since 2000. If you do the math, 20 years, 4,000 transactions, that's 200 transactions a year that Karen is closing, helping people get into their home or refinance their home. So Karen, would you mind introducing yourselves and sharing a little bit about yourself and Finance of America?
Hi, Kerwin. Thank you so much. And for all of you on this call, all we want to do is add value and be a resource for you. As Kerwin said and as Cornell said, first-time home buying programs are so important. And I have to tell you, I am not a down payment assistance program expert. I would refer you to a bank because the banks do have the money and the resources behind them. One of the things I'm passionate about, though, is working with first-time home buyers and walking you through the process. I am there with you for 3 years, 4 years, working on credit issues, helping you set aside a plan and setting a goal to set aside money for down payments and how to work with that, how to talk about, can you possibly get a cosigner or get a gift from somebody? The basic thing is putting yourself in a position to own a home and not overextending yourself. Talking about the down payment part of it as well as closing costs required. There are 2 different types of closing costs, recurring and non-recurring. We'll talk about those. It's important that you know what you have to have available when you are purchasing a home. So I've been lending in all 50 states, licensed in several that require it. So it's something I'm passionate about to be able to be available to you wherever you want to buy. So I'm excited to be part of this panel. Thank you for including me. This was kind of a last minute thing for me. So I'm a little bit less prepared, I think, so I apologize for that. But Kerwin, you've already started out by doing a great job. So thank you for that.
Perfect. Thank you. Thank you very much, Karen. Fernando, did you make it on the phone or on the WebEx? Okay. So I don't think, just for the audience out there, so we will have the contact information for both Alex Vega and Fernando Garces to send out and to provide to everybody in case you're looking to get specific information about products at HSBC or specific information about working with a nonprofit like VCCDC. So again, we might have them join shortly, but if not, then don't worry, we will be able to provide everybody with their contact information. So I want to transition a little bit, and again, for everybody on the phone, for all the panelists, I want you to be at ease. I look at this as just us having a conversation at a backyard barbecue where we're getting to know a little bit about each other, right? And I think those informal settings where we're getting to know about each other and each other's line of business is the best for us to learn about each other and how we can help each other. So again, for the folks who are online, who are listening to us, again, this is very informal get together. We're hoping to share some, to Karen's point, add some value, just share some tidbits of knowledge, and with the hopeful outcome that if there's something that intrigues you, something that sparks your interest, you'll reach out to one of these panelists after the call. But with that said, Cornell, can you tell me a little bit about the different types of programs that Bank of America currently offers and what it takes to qualify for some of these programs?
Absolutely. So the exciting programs that you mentioned earlier, there's some that are simple, 3% down. One is the Affordable Home Loan Solutions, and the other one is called Home Possible. Both of them only require 3% down. And what's exciting about it, Kerwin, is that Bank of America will supply that 3% down up to $10,000. So, for example, if you're buying a $300,000 house, 3% down to $9,000, you can get a grant from B of A for that $9,000. Obviously, you'd have to qualify for it. But not only that, but you can also get a grant for up to $7,500 that is towards closing costs. So, and that's non-recurring closing costs, of course. And in addition to that, of course, not so much in this market, but generally speaking, you can get seller concessions that can cover some of the recurring closing costs. So it's an exciting product that's getting a lot of people in the homes who thought that they couldn't afford before. I alluded earlier to the Shiva report, the State of Housing in Black America, and I would encourage everybody to read that. But one of the things that came out of that report this year is that the two main reasons people can't afford is down payment and credit. And one of the other exciting things, in addition to our being able to supply down payment and closing costs, is we also have what we call CTO partners, or connect to own partners. And these are people that are their own individual businesses or corporations that when we do have credit problems or even down payment savings problems, if they're buying a larger home, we can use these partners that are already vetted by B of A to help a client get ready for home ownership.
Great stuff there, Cornell. And hopefully everybody caught that there are products that will allow you to buy a home with as little as 3% down. I know a lot of clients that we talk to still think that, FHA is the only way to get a home with 3.5% down, but that's not necessarily the case. So thank you for pointing that out, Cornell.
Absolutely.
And I do believe that Fernando made it on the phone. Fernando, are you there? Fernando, if you're there, you're on mute. We can't hear you. All right, no worries. We'll come back.
There was a request to repeat the two programs, which are Affordable Loan Solutions and Home Possible. And you can reach me.
Correct.
I'm sure there'll be connection points afterwards, but they're both 3% down.
Mm-hmm.
Thanks.
So again, guys, if you're out in the audience, if something sparks your interest, make sure you write it down. There will be a Q&A section at the end. And again, we'll make sure to provide you with the specifics on those two programs. So let's transition over to Karen. So same question for you, Karen. Is there a product, at Finance of America or through all the different options that you're able to provide that helps first-time home buyers?
We have the same programs Cornell was talking about, the 3% down, the Home Possible. There's also one called Home Ready. Those do require a little bit higher credit scores, and some of them do have income limitations. So in the case of a lot of those, that's when we would actually possibly move you over to FHA with the 3.5% down. FHA will allow a lower credit score. The entire down payment can be gift, same as some of these other programs that Cornell was addressing. And in that particular case, what happens on FHA is you have a PMI, or private mortgage insurance premium is what they call it for FHA. That stays with you for the life of the loan. The programs that Cornell introduced, when you have mortgage insurance, those actually can be eliminated at some point. And we can get into that in more detail. So a lot of the first-time homebuyer programs are all the same. So when we're talking about the grants that are available and the down payment assistance programs that are available, those are going to be specific to you as a buyer. We have to take a look at your credit scores. We have to take a look at where the property is located. We have to take a look at what your income is, how many are in your household. We also have VA loans, and a VA loan, if you are a veteran and you haven't used your VA eligibility, you can come in with 0% down. There's a funding fee associated with that. So there are all types of things, and it's going to be specific to you. It's going to be specific to you as a buyer. So I can't probably expound on more than that. Cornell did a fabulous job of explaining what's available out there and what Bank of America has available for assisting with the down payment and the closing costs. And those are programs that are very important to understand. So we'd have to deal with you one-on-one to see exactly where you're at, again, what your income is, what your credit looks like, and what your needs are, to be able to walk you through which program best suits your situation.
Perfectly said. And just to piggyback on that, again, for the audience, there really isn't a cookie cutter approach to lending. Every client is a little bit different. Every client has different credit backgrounds, credit, maybe pros and cons, income. So it really behooves you to learn a little bit about everybody and all the different programs out there. So for the next question, we're going to stick with Karen. And Karen, what would you say is the first few steps that somebody should do when they're thinking about buying a home?
You really need to talk to an expert, a mortgage expert, right? You need to talk to them. Start with your why. Why do you want to purchase a home, and where do you want to live, and why is that area important to you? Then we talk about what type of income do you have? Are you hourly? It's important if you're hourly, or if you get bonus or commission, you have to have a certain history. You have to have a 2-year history of being an hourly employee to use that income. If you have a bonus or commission income, we need a history to show that that's going to be ongoing, that you've had that for at least 2 years. I talked to you about your credit. When I first start speaking with somebody, a lot of people are hesitant to let us run their credit report. It's hard for us as a mortgage advisor to tell you exactly what we can do for you until we can see what your credit profile looks like. That's a huge part of qualifying for homeownership. So it's important also that you understand, if I run your credit report, or Kerwin runs it, or Cornell runs it, and we all run it in a short period of time, your credit scores should be very similar. There should not be a negative impact for that, because it's obvious to the criteria that's putting this together, the algorithms, that you're shopping for a home loan, not purchasing 3 homes. So when you're afraid to let somebody run your credit report, it's hard for us to tell you where you're at. So when I'm talking to somebody and I start dealing with that, the first thing I want to know is child support going to show up on your credit report? Is the library book or Joe's Pizza, where you bounced a check years ago, going to show up on your credit report that turned into collection? A $10 collection account can lower your credit score dramatically depending on when it was placed on your credit report. So it helps us have a roadmap. With a roadmap, we can set goals with you, and we can talk to you about the next steps you have to take to get to the next level. But for me, I start with your credit and your income stream and how that works and how long you've been doing it on the job.
Great stuff there, Karen. So absolutely, first step is talk to a professional. So Cornell, transitioning over to you. So a lot of clients really don't know what it takes from a documentation and from a preparation standpoint to get a loan. Can you talk to us a little bit about what documentation a client should be ready to provide to a bank or to a lender?
Absolutely, and just to reinforce Karen's perspective, obviously the first thing in anything that's important is to talk to a professional. So whether it's Karen or any of the other lenders on here, make sure that you're dealing with somebody with a good level of experience, who understands and wants to do first-time home buyer and diverse segment buyers. From a documentation standpoint, Kerwin, I look at the 4 C's that go back way back. It's credit capacity, collateral, and cash. And how are you going to support each of those? For credit, obviously, you're going to need to make sure that your credit is as good as it can be. So the earlier you start in pulling your own credit, and understand that your FICO score that you get when you pull your own is not going to be the same one we get, but pull your own and see what it's all about. If it looks like you're going to need some assistance in cleaning up your credit, you can certainly do that. From a documentation standpoint on credit, we use just plain, as Karen mentioned, a credit report, but we all use our own individual credit report. So there's not much you can do to prep for that. From a preparation standpoint, the 2 key areas are going to be capacity. You're going to need probably 1, maybe 2 years of W-2s. You may need your tax returns if you're in business for yourself or you have rental property or other kinds of income. But generally speaking, you're going to need 2 years of W-2s. You're going to need a full month of pay stubs. So if you're paid 4 times a week, you'll need 4 of them. If you're paid twice a month, you'll need 2 of them, et cetera. So 1 full month of pay stubs, 2 years of W-2s, and then you're going to need bank statements, but not just, make sure when you do bring in your bank statements that you've looked at them carefully, because the lender is going to look for NSFs or non-sufficient funds activities. Are you bouncing checks, essentially? Make sure that when you bring in your 2 months of bank statements, that there's no unusual activity on there. And lenders will look for high and consistent payments that are coming out of your bank account. So if you've got high and consistent payments coming out of your bank account, make sure you're ready to explain what those are. Very important. So 2 years of W-2s, 2 months of bank statements, 1 month of pay stubs. That's generally the documentation, generally the kind of preparation that you're going to want to do as you get ready for your application. You may also want to have a conversation again with your professional loan officer to figure out what specific other kinds of documentation you might be required to bring in. If you have other kinds of income, as an example.
Can I add something to that?
Please.
So to Cornell's point on your bank statements, looking for, consistent payments going out, they're looking to see, are you paying child support that you didn't disclose? Are you paying, a car payment, something that you didn't disclose, right? Because that helps with that can actually affect your qualification. The other thing is, I know a lot of you have cash. Be careful with cash deposits. We have the Patriot Act, right? They're looking for money laundering. They're looking for borrowed funds. So you're going to have to source large deposits. When you can't support it with a paycheck stub, you don't want to start depositing $2,000 and $3,000 in cash payments that you can't support where it came from. It looks like borrowed funds. And those are things that we run into quite a bit, especially with first-time homebuyers. You've been saving your money and setting it aside. We used to call it mattress money. And so some of the programs, Cornell, you guys might have one, or Kerwin, you guys might have one where you're allowing cash. I believe FHA allows it if it makes sense for the type of work that you do. But it is certainly something that they do monitor. So I just wanted to add that to the bank statement part of it.
Very, very true. Cornell, we'll stick with you here, and you mentioned credit cleanup, right? So as a lending officer, do you have resources if somebody comes to you and they're not quite ready from a credit perspective to help somebody eventually get to home ownership?
I do, Kerwin. As I mentioned earlier, we call them CTOs, or Connect to Own Partners. And these are individual companies that specialize in helping you get ready to buy your first home or to buy your second home, if that's the case. So let's say, as an example, that you've got a collection account from a medical bill. These companies can help you to clean that up, get that medical bill paid off, and then sometimes get it removed from the credit bureau because it's now paid. It looks like there are people trying to get into the system, so I'm just going to shout out to Colleen. I'm not sure what can be done, but yes, the Connect to Own Partners help out tremendously to help a prospective buyer get ready. Our Connect to Own Partners can also help you with, as an example, establishing a savings plan. So while you can certainly get 3% of your down payment from Bank of America's grants in some cases, and even closing costs up to $7,500, sometimes you'll want to have money only for your earnest money deposit, the amount that you're going to show your seller that you're sincere by putting into escrow towards your purchase. So our Connect to Home partners are hugely helpful in helping you get ready for debt, improving your debt to income ratio, improving your credit, and also helping you to establish your savings account.
Okay. So moving over to Karen. Karen, obviously buying a home, it's not just the lender, right? The other major party involved is the realtor. So do you think, as a first-time home buyer, I should talk to the realtor first or the lender first, and why?
I think you should talk to the lender first. Your realtor is hesitant to take you out to look at homes if you haven't started the pre-approval process. So especially now with the COVID criteria, it's a lot different, and that is people don't want you in your home if you haven't started working with a lender. But as Kerwin and Cornell we've been talking about, is if you don't have the collateral piece and the credit piece and all of that stuff going for you, then you're not ready to buy a home. So a realtor is going to spend a lot of time with you, and they're going to develop a relationship with you, and they're going to spend their time taking you out to show you properties. You may be 2 years away from being able to purchase. You may need to work with the CTO that Cornell has. I also have a credit repair person that helps with some of those things. And most of us who've been doing this for years do have a resource for that to help you along those lines. So if you go to a realtor first and they start showing you property, you're going to fall in love with something for $500,000 and maybe you can only afford $350,000. So now you've gotten your hopes up and your expectation up, and you can't have that home. You need to start with one of us as an expert to guide you through that process and start setting those goals for you to say, with this amount of money, this is what you can afford. Here's what you need for a down payment. Here's what we need to do on your credit end. So for me, I just say 100% you need to start with a lender.
Agreed. We'll stick with Karen here. Karen, what are some common mistakes or pitfalls that you've seen some clients, mistakenly do once they're already in the process of applying and maybe already have a pre-approval with you, deter them from actually crossing the finish line and getting the keys to that home?
Purchasing a new car, opening a credit card. You have to have that big screen TV for the new house, right? So you get really excited and you go out there and you start charging up all these credit cards. Well, guess what? Your credit report will be pulled again on the back end. We call it a soft pull, but they will pull it again on the back end and they'll double check to make sure that your position for qualifying, we call them debt to income ratios. In other words, how much debt do you have based on your monthly income that we've already verified, right? So every program has a different threshold for how much money you have available to use for your housing expense and your car expense or your credit cards or whatever you have as ongoing obligations. So when you're looking for a home and you talk to one of us and we tell you, here's what you qualify for, this is what we're looking at, don't go buy anything unless you talk to one of us and let us tell you, you have room to have a $10 a month payment or you can't have that home.
Absolutely. We're getting some questions in the chat box here as far as, do you have any specific examples of if I make X amount of money, how much I can afford? And really that kind of talks to what we call, as lenders call, debt to income ratios. So Cornell, do you want to give us just a ballpark of some examples of debt to income ratios? Let's say I make $10,000 gross a month. What should I be looking at as far as debt to income ratios?
Wow. Well, if you're making $10,000 a month, you're probably not looking for your first-time home buyer, Kerwin. Good question. I wish I could do that. And anybody that typically does isn't really doing you a favor because there's so many variables, as Karen alluded to. So let's say, as an example, that you're making $10,000 a month, but you're driving a Jag, and that payment is, I don't know, let's toss out a number, $2,000 a month. So now what can you afford? And of course, if you're making $10,000 a month, you're shopping at Nordstrom's and Magnum, and you've got credit cards from Chase and Citi, and let's say that's another $3,000. Let's say you're right out of college and you're a great attorney, and now what does that mean? Well, it means you probably have student debt. What is that? Student debt for an attorney can be a couple $100,000 by the time an attorney is out there. So the variables are way too great for guesstimation. The right answer, as Karen alluded to earlier, is talk to a professional. Get your credit bureau report pulled. take a look at your real debt to income ratio. Let us tell you how much of that you have left over to buy a home. Another variable, once you're in the home ownership arena, is are you going to buy a single family residence, a PUD, or a condo? That can make a difference in something called HOA, Homeowners Association dues. And you would be surprised how a simple $300 HOA can destroy your debt ratio. So you need to start off giving someone a call, whether it's somebody on this call or someone you know, get your credit pulled, figure out what your debts are, and then get a real debt ratio.
Well said. Well said. Let's transition back to Karen. Karen, what are some common things that people, or what are some things that people don't really know about being a homeowner? Maybe it's supplemental taxes, maybe it's property taxes. You know, do you have any feedback, any stories about any clients that said, "Oh, I didn't know this is part of being a homeowner"? You have anything you want to share about that?
Yeah, and I'm glad you gave Cornell that last question about what they qualify for with 10 grand. I was trying not to laugh, Cornell. You did a fabulous job on that, by the way. So, yeah, one of the things that we talk about a lot, and this is part of wanting to deal with an expert and deal with a lender before you start looking, is that when you pay your rent, you just paid your rent for November. You always pay your rent 30 days in advance. So as you pay your rent 30 days in advance, okay, you are already paid for the entire month. When you have a mortgage payment, you always pay 30 days in arrears or 30 days behind, because a lender, just like a credit card, right? If you charge a credit card today, you didn't pay for it already in advance. They didn't know what you were going to charge. So same with a lender. So some of the things that you need to pay attention to are how much it's closing costs, right? So you're going to have property taxes that you don't have when you pay rent. You're going to have property taxes in California are calculated with most lenders at 1.25% of the purchase price. So if you purchase a home for $100,000, you're going to have property taxes of $1,250 for that year. And then we have to break that down to calculate your debt to income ratios to state, okay, it's going to be $110 a month or whatever. So when you purchase a home, typically the property taxes that you get assessed when you receive your first tax bill are based on the seller's property taxes. So if you purchased for $100,000, chances are they purchased for $60,000 or $70,000, depending on how long they have owned their home. So their property taxes might be $600 a year. You're going to get your first tax bill and you're going to say, oh, score me, I'm only paying $600. 3 months later, 4 months later, you will receive a supplemental tax bill and you do owe that money. But for most of you as first-time home buyers, you will have what we call an escrow account or an impound account where they're collecting with your monthly payment your property taxes and your homeowner's insurance for you. So that when you get that supplemental bill, it's important that you call one of us and say, what do I do with this? I'll do a conference call with you to your current loan servicer. They've already been holding your money. They've been collecting it on a monthly basis for you. So I will always call them with you and say, we know you have this money. We need you to pay it. Otherwise, your payment structure is going to change. So you also have utilities that you may not have to have right now when you're in an apartment. Trash pickup, all that kind of stuff. Some are included in property taxes. Some are separate bills, right? Mine's in my property taxes and my mom pays her separately. So those are all things you need to be aware of. All the gas, the electric, the water, some are joined together, some are individual bills. So there's a lot to go with that. And also when you're doing first-time home ownership, sometimes 3% down is better than 5% down. If you're taking every single penny you have to purchase that home, what are you going to do if your water heater breaks and you don't have a home warranty or something goes wrong with your house? I mean, you really need to be prepared, which again is why you need to speak to an expert before you start moving along those lines and using and thinking you're going to use every penny you have for that.
Okay. Karen, we've been talking a lot about W-2 employees or people that work for big corporations. If I'm a small business owner, what if I have my own business? What should I expect from a documentation standpoint, from ratios, or just any feedback if I'm self-employed?
On self-employed, if you're a small business owner, you're probably, and any of you on this call, if you are a small business owner, you probably know what I'm talking about, a sole proprietor or Schedule C. You don't have a corporation necessarily. Maybe you don't have a partnership. So your income is claimed and taken care of inside of your own personal tax returns. So we call that a sole proprietorship, and we call that a Schedule C. So every day somebody calls me and says, I make $100,000 a year. And I ask you if that's gross or net. And you tell me that's net because it's your money. But your tax preparer has written off $70,000. So your true income that I can use is $30,000. That changes your whole dynamic. So again, in speaking with a lender first, we would start with 2 years tax returns. We would take a 2-year average. We would take a look at what you typically write off. Is there anything in there? If you use part of your home for business use, we can actually add that number back into your final income figure. So if your final income figure is, let's say, $30,000, but you had $10,000 in home office use, we can add that back in, which increases your income. If you have mileage, we can sometimes add back mileage if you're claiming that for the type of job that you have. So for a small business owner, we at a minimum need 2 years tax returns for starters. And then we want to see right now, especially because of COVID, they're going to ask you for probably 2 months business bank statements to see whether or not your business is still viable and if you are still depositing money in that business account. Some of you don't have business accounts that are separate, so they're going to ask you to prove as we move through the process that your company is still doing that. If you have a small business and your business paid your car payment, then we don't have to count that against your debt to income ratios. If you can prove with 12 months canceled checks, most of you don't know what canceled checks are, right? Or proof with 12 months bank statements that it's coming out of a business account. So talk to one of us about whether or not, or talk to a CPA or an attorney, financial advisor. I don't want to be that person to you. Talk to them about having a separate business account so you can actually separate your true business expenses and separate them out from your personal expenses.
If I'm retired or planning on retirement, how does that retirement income affect the purchase of a home, and what documentation would you need if I was retired?
You're going in and out. Is that for Cornell?
I was going to. Oh, okay. And yeah, you were breaking in and out. Thanks, Karen. And if I understand, the question is what kind of documentation is needed when you're retiring or are retired?
Correct.
Okay. So what we look for is the same thing in retirement as we would in employment, and that is that the income is stable and consistent and is expected to continue for the foreseeable future. So the prime example, of course, is Social Security. We would ask for the Social Security award letter. We would look for the 1099 or the equivalent of W-2 from the prior year to show what that income was. If it's a disability, we'd want to make sure that the disability is a permanent disability. We're not concerned with the medical condition. We just want to make sure that the income that you're claiming is going to be consistent. If your retirement is pension, that's easier as well. We'd look for your pension award letter, and we'd look for the fact that it's going to continue in the foreseeable future. And foreseeable future, generally speaking, means about 3 years, but we'll look for, sometimes we'll get into tax returns, but not generally. Generally, the 1099 or your retirement statement and current bank statements showing that the income is actually going into the bank as a deposit.
Thank you, Cornell. So wrapping up here, guys, Cornell, what one piece of advice would you have to somebody who's looking to buy a home, whether it be how to choose a lender, what product, how to choose a realtor? Just what's one piece of advice you have for everybody on the line?
I would reinforce what Karen said. Start with a professional. Get on the horn with someone in lending who understands the business, someone that you know that understands first-time home buyers and has a commitment to the diverse segment population and first-time home ownership. So start with a professional. They'll help guide you through what you're going to need from an income standpoint, what you're going to need from a credit standpoint. You'll want a lender, in my opinion, that has a widest array of products, because for two reasons. One is the product itself, such as a 3% down or FHA or VA. But secondly, and more importantly, is it shows the lender's commitment to that particular program. It's tough to have a commitment to a first-time homebuyer, as an example, program if you don't have a 3% down product. It's tough to have a commitment or to show or demonstrate a commitment if you don't have grants available, or you're not familiar with MCCs, mortgage credit certificates, or you aren't used to or don't understand how Section 8 can actually work to help you buy a home. So you need to have a lender who's familiar with the program and who's committed and dedicated to the programs.
Same question to you. What one piece of advice would you have for the folks listening out there, whether it's mortgage related, lending related, realtor related, any best practice?
Make sure they're listening to you, because this is going to be your home. And in a lot of cases, it's not your home for 6 months or 1 year. In a lot of cases, it's your home for 5 years or 7 years or 10 years, depending on where you're at. So make sure they're listening. I have on the top of my computer, it says, ask more, listen more, talk less. If they're not paying attention to you, then you're just another number to them. And when you're in this situation and you're doing a first-time home buyer, you're a first-time home buyer, you need to make sure when you call them, you don't want them to go, I'm sorry, what was your last name again? You want to know that they've been paying attention to what your needs are, that you have 3 kids, that a 2-bedroom isn't going to work for you because one's older, or you have 2 boys and a girl, whatever, or you have a baby, or you have an in-law living with you. So just make sure that the relationship is there, that the person that you're dealing with is passionate about what they do. And I can tell you right now, after 35 years of lending, Cornell's passionate about what he does. And it's huge to be able to get on a panel where we can't see you, right? So we're talking to ourselves. It's hard to show passion if you're not passionate, right? So you want to talk to somebody who really, really listens and cares about your situation and wants to give you the best advice and isn't always too busy for you. If they're too busy for you, then it's not going to be the person for you, because once you are under contract, you're going to have a lot of questions. You're going to need a lot of hand holding, and you got to make sure if we're here for you on the pre-approval stage, then we're going to be here for you when you're actually under contract. So just get a feeling about, not everybody works well with a woman. Not everybody works well with a man. So you got to just go with what your gut feeling is, at least for starters, and just make sure they're listening and you're getting your answers.
Thank you very much. Colleen, I think we have time for 1 or 2 questions. I think we touched on everything in the chat. Are there any other questions that you see, Colleen, or do we want to open up the lines?
There was one that I thought was kind of 2, actually. There was one in regards to do you have any grants or work with NHCA loans?
So, Karen, do you do anything with NACA?
I would say, Cornell, I got to defer that to you.
B of A participates in NACA, but we don't have loans that we do on the retail side that work with NACA.
Correct.
I do have another question. I own 3 rental properties and 1 house I live in. I'd like to buy a distressed property to fix it up and flip it to sell at a decent price. Is there money to help someone like me?
I'll take the first part of that, and Cornell and Karen can jump in. Usually when we're talking about down payment assistance and grants, those programs are for properties that you're going to live in. So for primary residences, I would say there's very little, if any, grants and down payment assistance when buying a investment property like that. But with that said, again, there are nonprofits that specialize in that. So I would refer you to a local nonprofit like BCCDC. But Karen, Cornell, anything you want to add to that?
If you own rental properties and your own home, you're not considered a first-time home buyer. So you could take equity out of one of your properties. You're not in a situation where you need the same level of assistance as a lot of these people on the call. So I would say to you, if you have equity, if you own 3 rental properties and your own home, you are doing absolutely fantastic. So what you need is to take equity out of one of your properties. You probably don't want to do that. It's always better if somebody is willing to give you money, quote unquote, for free, right? Or help you where you don't have to take it out yourself. But I would say, hey, good for you. Take equity out of one of your properties and use that. You can take a line of credit on one of your properties, right? You're owner occupied. Use that to do the fix and flip, sell it, and pay your line of credit off.
So just to add a little bit, if you were buying another owner-occupied property, then yes, B of A has programs that can help you, and they even include grants. But if you're buying to fix and flip, then what Karen and Kerwin said.
All right. So again, guys, I want to say thank you to our panelists. Thank you for participating in the discussion. Thank you for your feedback. Thank you for addressing some of the questions that our audience had. And I just want to remind everybody who's on the phone that we do have another panel starting at 1 o'clock. You can use the same link that you used for this panel. And without any further ado, I do want to pass it back to Sonia Blake, President and CEO of the Valley Economic Alliance.
Kerwin, before we depart, should we give contact information, or is that going to be done separately?
We will email out to all of the registered participants your contact information for that connection. So thank you so much for mentioning that.
Thank you, Sonia.
Thank you, all of the speakers. Wow, what a great panel and some great information. So knowledgeable and very helpful. Really appreciate it. We're so grateful for your participation. And yes, so not to worry if you missed any of the details. We're going to make the recording available to our registrants along with the email or the contact information for all of our speakers for those one-on-one consultations where you can get into those case-by-case questions and really drill down on the finer details of how you can really take action on what you've learned today. So I'd also like to thank our sponsors once again for their ongoing support. Our presenting sponsors were Boston Private and Bank of America. Our panel sponsors were HSBC Bank and SB Realty. Our community partner, Ventura County Community Development Corporation, and our media partner, San Fernando Valley Business Journal. So grateful for that support. So as Kerwin mentioned, our next panel today is at 1 p.m. Let me tell you about the topics we'll be covering. Purchasing an investment property, lines of credit, refinancing, reverse mortgage and investment options. So you'll be able to learn what options you might have when it comes to getting into investing in real estate, understanding the different ways to utilize equity in your home, lending and improvement loans that can increase the value, and the ins and outs of purchasing a second property. So we talked about the first step today and this morning, and we'll talk about the next step this afternoon. I want to thank you all for joining us today, and we look forward to hosting you at the next event today at 1 p.m. Thank you so much, and see you at 1.
Thank you again.